Hello everyone and welcome to Managerial Accounting. In today's video we're going to be covering Chapter 20, which is about cost, volume, profit analysis. I think this is a very practical and realistic chapter because we go over what we call it like the break-even point. What is the amount of production that we should produce in order to be able to cover our cost? And I think there's a lot of applications. I think this is one of those chapters that I find to be very useful in real life. The first thing that we're going to be talking about is something called cost behavior. So in cost behavior, this is the manner in which a cost changes as a related activity changes. So when an activity increases, then we expect the cost to increase. So the behavior of cost depends on two elements or two factors. The first thing is identifying the activities that cause the cost to change, which are called the activity drivers, or sometimes we call them the activity bases. The other thing is the relevant range, where we specify the range of activity over which the changes in the cost are of interest, and we call it again the relevant range. So costs are normally classified as either variable cost, fixed cost, or third category, which is a mixed cost, which is a mix between variable and fixed. So let's start with a variable cost. Variable costs vary in proportion to changes in the activity base. So in other words, when we produce more, we expect that the cost would go higher. And think about any thing that we produce, the components, the material, is something that would increase the more we increase the production. So when the activity base is units produced, direct material and direct labor costs are normally classified as variable cost. So assume that Jason Sound Incorporated produces stereo systems, and for a specific model, which is JS12, the relevant range is between 5,000 to 30,000 units, and that's the range of production. So in this table here you can see that this is the number of units of that particular model produced, ranging from 5,000 all the way to 30,000. You see here that the direct material cost per unit is $10. And one of those things that we'll learn that the cost per unit for variable cost is usually fixed. So the cost per unit is fixed, but the total material cost would increase as the units of production increase. So cost per unit remains the same regardless of changes in the activity base. However, the total cost changes in proportion to changes in the activity base. So I think this graph would give us an idea here. Like here on the x-axis we have the units produced for that particular model between 0 and 30,000. And here's the total direct material cost. As the number of units increase, or the number of units produced increase, the total direct material cost would go up. Let's see here the relationship is linear, but there's a slope here. But on the same side, or in the same direction, we can think about the units produced versus the direct material cost per unit, not the total cost. In here it's stable, 10 units, whatever, or it doesn't matter whether we are producing 1 unit versus 30,000 units. So the cost per unit is always $10. So some examples of variable cost and their activity bases. So for example, in universities, the cost would be instructor salaries. That's would increase with the number of classes that instructor would be teaching. For airlines, the amount of fuel, which is the cost, would increase based on the number of miles flown. In manufacturing, any manufacturing business, the direct material used, or the cost of direct material, would be based on the number of units produced. In a hospital, the nurse wages would be based on the number of patients. The more the patients, the more the wages. In a hotel, like the housekeeping wages cost is based on the number of guests. And in a bank, the teller wages would be somehow related to the number of banking transactions. Of course, there are some variations, but here we assume that these are all examples of variable costs. Now let's compare that to fixed cost. So fixed costs are costs that remain the same in total dollar amounts as the activity base change. So in other words, it doesn't really matter whether we are producing 1 unit versus 100 versus 1,000. The amount of cost would be the same. So in the activity base is units produced, manufacturing overhead costs such as straight line depreciation are classified as fixed cost. Because, for example, depreciation is not going to change based on production in many cases, especially like a building depreciation, for example. Of course, if it's a machinery, it's different. But let's talk about a building. The building depreciation is, if we're assuming straight line depreciation, then it's going to be fixed year after year. It doesn't matter how much the production is. So let's see an example. Assume that Minton Incorporated manufactures bottles and distribute perfumes, and the relevant range is between 50,000 to 300,000 bottles of perfumes. So in the first column here we have the number of bottles of perfume produced. The second column we have the total salary for one of the employees, let's say the manager, and then the third column would be the salary per bottle of perfume produced. You see here that the total salary does not change whether the company is producing 50,000 bottles or 300,000. But if you look at the salary per bottle of perfume produced, it will keep going up as the production increases. And that's why sometimes for these companies, when they produce more, they have much more advantage, especially with fixed cost. So the fixed cost per bottle decreases as the units produced increase, because the fixed cost is spread over a larger number of bottles, but the salary stays the same. And that's an important thing to keep in mind. So let's see this diagram or this graph, because I think it will give us a better idea. So you can see here the units produced and the total supervisory salary. It's fixed. It's $75,000 whether they produce 1 unit versus 300,000 units. It's 75,000. But if we look at it from the perspective of unit fixed cost, then the supervisory salary per unit will keep going down as the units of production increases. Here we have an example, or different examples, like going back to some of the examples that we had before. For a university, for example, the building depreciation, assuming we're using straight line depreciation, and the activity base number of students. In this case, the building depreciation would still be the same. It's going to be, it's not going to change. For a passenger airline, an airplane depreciation, again, assuming straight line depreciation, again, whether they flew at 1 mile or like 100,000 miles, it doesn't make a difference. The depreciation is going to be fixed from year to year. Again, under the assumption that we're using straight line depreciation. In an example of manufacturing firm, the plant manager's salary, again, that's always going to be fixed. It doesn't matter how many units are produced. In a hospital, the property insurance is a fixed amount. It doesn't really get impacted by the number of patients. The same thing for a hotel. The property taxes are the same whether we have 1 guest or 2,000 guests. It doesn't matter. In a bank, the branch manager's salary, again, is not really impacted by the number of customer accounts. So now let's see the third category of cost, which is the mixed cost, which has a different or a mixed flavor of variable and fixed cost. So mixed costs are costs that have characteristics of both a variable and a fixed cost. Fixed costs are sometimes called semi-variable or semi-fixed. Again, let's see this example. Assume Simpson Incorporated manufactures sales using rented machinery with the rental charges as follows. So the rental charge is $15,000 per year plus $1 for each hour used in excess of 10,000 hours. So the rental charges for various hours used within the relevant range of 8,000 hours to 40,000 hours would be as follows. So here we have the 8,000 hours, 12,000, 20, and 40. The rental charge was 15,000 up to 10,000 hours. So anything over 10,000, then the extra amount is going to be multiplied by 1. So for example here, when we have 12,000 hours, we take the 15, which is the fixed amount, plus we see how many hours over the 10,000, which is 12 minus 10, that's 2,000, multiplied by 1, that's again $2,000. We take the 2,000 plus the 15,000, that would be 17,000. Let's see the 20,000 hours. Again, we have the 15,000, which is our fixed charge, or the fixed rental charge up to 10,000 hours. Then we take the 20,000 minus the 10, which would be the extra hours. And here we have 10,000 hours multiplied by 1, that's 10,000, plus the 15, that's 25, and so on. So you see here we have a fixed component plus a variable component. And I think a similar example would be like, even though it's not a perfect example here, but when people lease a car, for example, they long-term lease, they let's say they pay for the entire year about, let's say, $4,000, and for any mileage over 10,000 or 12,000 hour, whatever the car dealership decide on, would be, let's say, 20 cents per mile. So that's a mix between a fixed cost that you know, plus some variable cost depending on the extra mileage that you drove the car. So here you can see that the cost is fixed up to 10,000 hours, but over that we have the variable factor, which make the slope goes up. Now we're going to be talking about a method used to calculate the fixed and the variable components in the mixed cost kind of situations. And this method is called the high-low method. So the high-low method is a cost method, or a cost estimation method, that separates mixed cost into their fixed and variable components. So that's the purpose of this method, is to know what is the fixed portion and what is the variable component or portion. The high-low method uses the highest and lowest activity levels and the related cost to estimate the variable cost per unit and the fixed cost. Let's see an example, because I think in this situation an example would make it much easier for us. Assume that the equipment maintenance department of Kaysen Incorporated incurred the following cost. And here we have 5 months starting from June all the way to October, and these are the units produced: 1,000, 1,500, 2,100, 1,800, 750, and here we have the total cost for each month. The number of units produced is the activity base, and the relevant range is the units produced between June and October. So from its name, high and low, we're going to look for the highest and lowest month of production. So you see here, August is the highest, 2,100. October is the lowest for 750. So for Carson, the difference between the units produced and the total cost at the highest and lowest levels of production would be as follows. We took the highest level, which I believe was August here, 2,100, and the total cost for that month was 61,500. We subtract from it the lowest, which was October, 750, and the total cost for that month was 41,250. And we got the difference here, 1,350 in number of units and 20,250 in terms of total cost. So the 20,250 difference in the total cost is the change in the total variable cost, and dividing this difference of 2,250 by the difference in production is an estimate of the variable cost per unit. So let's see how this works. We take the difference in total cost, which is the 20,250, and we divide it by the difference in units produced. Okay, so we get the highest, lowest, subtract them in terms of units and in terms of cost, and then we divide the cost by the units, or the difference in cost by the difference in units. So if we take 20,250 divided by 1,350, that would be $15 per unit. So now we got the variable cost. Let's try to calculate the fixed cost. So how we do that? The fixed cost is equal to total cost minus the variable cost per unit multiplied by the units produced. We can use any of the numbers, any of the high or low numbers. We cannot use the numbers in between, but any of the high or low numbers. So if we decided to go with the high levels, the 2,100 units, so the total cost minus the variable cost multiplied by the units multiplied by units produced would give us the amount of fixed cost. So how we do that? We know that the fixed cost or the total cost is 61,500. And we know the variable cost that we just calculated is 15. We'll multiply by 2,100 units, which was the highest level, and that would give us 31,500. So subtract the 31,500 from the 61,500, and that would be 30,000. If we decide to go with the lowest level, same thing, same model. Total cost minus, between parentheses, variable cost per unit multiplied by units produced. And make sure that you do these separately. Okay? So we get the 41,250 minus, and then we open a bracket, 15 multiplied by 750. So these should be done separately. Okay, so it's 41,250 minus 11,250, which will give us, again, the 30,000. So that's our fixed cost. So using the variable cost per unit and the fixed cost, the total equipment maintenance cost can be computed for various levels of production. So let's assume that we want to calculate it or estimate it for 2,000 units of production. We take the 15 multiplied by 2,000 plus the fixed cost portion. So that would be 30,000 plus another 30,000, that would be 60,000 in total. So let's try to summarize the difference between variable and fixed cost behavior. So for variable cost, the total amount increases and decreases proportional with activity level. The fixed cost, on the other hand, remains the same regardless of activity level. And again here, we're talking about the total amount, the total cost. But the per unit amount for variable is actually fixed. So it remains the same regardless of activity level. Remember when we had a same value of $10 per unit of production? Yes, but the total variable or the total variable cost would keep increasing with the units of production. On the other hand, for fixed cost, it increases and decreases inversely or opposite with activity level. So when we increase the activity, the cost per unit, the fixed cost per unit goes down. And if we decrease activity, then the cost per unit would go up. The fixed cost per unit would go up. Let's do some summary of variable cost, fixed cost, and mixed cost. So variable cost, examples would be direct material, direct labor, electricity expenses, because that would be an expense that would increase with production, supplies. For fixed cost, straight line depreciation, it's a fixed amount, property taxes, insurance expense, production supervisory salaries. A mixed cost would have a flavor of both. So things like quality control department salaries, purchasing department salaries, maintenance expense, warehouse expenses. These are typically good examples for costs that would be categorized as mixed cost. So let's try a knowledge check activity here. Which of the following costs remain the same regardless of activity level within the relevant range? Which of the following costs remain the same regardless of the activity level? Is it variable cost or fixed cost? So I think the thing that stays the same is the total fixed cost. So it has to be either B or D. And what is the other thing that stays the same regardless of the activity level? The variable cost or the unit variable cost or the unit fixed cost? I think unit variable cost, and I always remember this $10. The $10 is always fixed. So the right answer would be B, total fixed cost and unit variable cost. So cost behavior will vary based on changing activity levels. Total variable cost and unit fixed cost will either increase or decrease. However, total fixed cost and unit variable cost will remain the same regardless of activity level within the relevant range. Alright, so let me stop here. In the next video, we're going to be going over cost, volume, profit relationships.